Hello, and welcome to the August 2024 edition of the U.S. Energy Insights. I am your host, Pamela Munger, and I'll be taking a look at the latest trends and market conditions within U.S. and global energy and sharing actionable insights powered by Vortexa's tracking analytics. In this insight, we will cover Atlantic Basin crude exports, OPEC versus non-OPEC crude exports, Atlantic Basin gasoline and diesel markets. And here with us to talk crude markets, I have invited my esteemed colleague, Senior Market Analyst Rohit Rathod from the Houston office to chat with us and share his thoughts. Hi, Rohit. As we look forward, we can see that all of the major agencies are revising downward their oil demand growth outlook for 2024. This raises the question around the need for rising crude supplies. What are you seeing?
Hi, Pam. Thank you for having me over for this edition of the US Energy Insights. Now, what we have observed in the Atlantic Basin, and let us start from the US itself, we have seen a decline in US exports actually pointed towards Asia. Most of these barrels, again, light sweet barrels. Now, the key reason for this has been a general lack of demand from Asia, and also even with the Asian refiners where they are still buying these crudes, they have a preference for grades from within the east of Suez markets themselves. Now, you could call it sort of a boon for US crude exports has been the situation that has developed in Libya and Algeria. Libya, especially, we know that the production is supposed to remain offline for much longer. And as a result of this development, there has been a renewed interest from European buyers for US crude, and these US barrels will be continuing to flow into the European markets. Now, moving further down south into Atlantic Basin, let's just concentrate on South Atlantic. So in the South Atlantic, especially on the east coast of South America, we have one supplier, namely Guyana, where we are observing crude exports, which are again back to around 600,000 barrels per day. Now, these levels were last seen in May, and since then they had a turnaround at their offshore production platforms. These platforms are now back from those planned maintenances and are producing at capacity. And as a result of that, we are seeing increased exports coming out of Guyana. Now, most of these exports are again going into the European market. So that is helping that European demand. On the West African side of things as well, we have increased exports coming from two key suppliers. So that's Nigeria and Angola. What was surprising from Nigeria especially is that, instead of these barrels going into the Dangote refinery, which has recently started up, these barrels are actually headed to European markets again. Chinese demand hasn't picked up, but some of these barrels from other West African players, such as Angola and smaller players like Gabon, Chad, these are still have found buyers in the Chinese market. Moving on, coming over to Dangote, we are seeing this refinery actually ramping up pretty well. We are seeing steady arrivals of crude into this refinery as well. In terms of what we are seeing in terms of product exports, is that they are producing diesel, jet kero, as well as naphtha and fuel oil, and it is also being loaded from Dangote as well. So there has been pretty strong product loadings as well, and this has continued over from June, July, and even into August so far. Before we focus on OPEC and non-OPEC crude exports, let us just come back over to the North American continent and let's focus on Trans Mountain expansion. So since this expanded pipeline came into service in May, we have had significant amount of crude being exported out of Vancouver. Now, after the startup in May, and when the exports ramped up in June, we had most of these barrels in June heading to Asian destinations, so China mainly, and also cargo going to India as well. In July, these exports increased to 350,000 barrels per day. But again, this time around, majority of the barrels remained within the region. So most of these barrels were absorbed within the US West Coast refining system. one cargo did end up in South Korea as well in this month. So far, in August, we are seeing similar volumes as July, so around the same 350,000 barrels per day. Again, these barrels will remain in the US West Coast, but there is again going to be some barrels which are actually destined for China. So they'll be doing STS transfers offshore Los Angeles in the Pacific Lightning Zone. But another impact that we observed of this Trans Mountain startup was actually the share of competing heavy sour barrels in this US West Coast or America's West Coast market. Now, what happened over here was as more transport or more Canadian crude came into the US West Coast, it pushed back some of the barrels from other LATAM producers. So especially, Zapoteco, Napo, Oriente barrels, which earlier used to come into the US West Coast. They were pushed out. Well, these barrels still, they're not doing that bad because they were able to find homes in other Pacific Basin buyers, such as, places like South Korea, in China, as well as in India. Now, finally, coming over to the OPEC versus non-OPEC crude exports, what we have seen over here is that there has been a significant uptick in non-OPEC plus crude exports. And this is all a culmination of the earlier producers that we were talking about, be it the US, be it Guyana, or other players in the Atlantic Basin. Now, there has also been a resurgence in OPEC plus exports as well. We have been observing that increase as well, and this is excluding Iran and Venezuela. Now, with these increases coming in from both the players, the question still remains to be seen is, will OPEC still unwind their cuts in October? Or even if they do unwind, it might just be a lip service kind of thing, because at the levels the crude prices are right now, there is very little incentive for OPEC Plus to push in more barrels into a market where there is a surplus of crude, but the demand is sort of lacking.
Thank you, Rohit, for sharing your very knowledgeable and detailed observations with us. Certainly, there's a lot to look out for as we go forward in the year into the second half and the fourth quarter. Thank you for joining.
Thank you.
Now let's take a look at the clean product markets. Clean product margins appear to have found a floor after softening in the last few weeks, despite lackluster demand, even in expected hotspots. Regardless of the recent and temporary uplift in gasoline margins, predominantly in the US, global gasoline and blending component arrivals into the top 100 gasoline import ports, a figure exclusively used by Vortexa to indicate whether there's true demand in certain pockets, which are located by excluding trading hubs such as ARA and Singapore, and whether or not this chart could point to a future of further disappointment. And after several months above last year's levels from March to May, these arrivals look to be heading lower if you look at the red line, and possibly even below the 8-year average. Underpinning this fall in demand has been largely driven by PAD 1, where seaborne imports from Europe have been observed 16% lower in June 2024 year on year. This is normally peak import month. Low import requirements from PAD 1 have been especially surprising amid a backdrop of suppressed refinery run rates, below 95% for the past 5 weeks, according to the EIA. And this is in both PAD 1 and PAD 3. Also to note, despite Brazil's strong diesel demand for its heavy vehicle fleet, South American gasoline arrivals for January through July of this year have dropped by 36% when compared to January through July of 2023. Meanwhile, Europe continues to respond to lower than expected gasoline buying from PAD 1 and to some extent West Africa by decreasing gasoline loadings to the lowest levels since September 2020, when much of the Atlantic Basin was reeling under the impact of the pandemic. On the other hand, surprisingly, we see that diesel and gas oil arrivals to the top 100 diesel import ports continues above the 8-year range. European gas oil demand in the first half of 2024 was 50,000 barrels per day below the same period in 2020, according to the IEA. And recent PMI indicators show the Eurozone manufacturing PMIs coming in at around 45.8, while China continues at 49.8. And despite middle distillate stock builds in Europe and slower demand, diesel gas oil imports into the EU 27 and the UK continue. The arbitrage has remained slightly opened from the Middle East, aided by the ability to move diesel cargoes on larger vessels. And we have also seen US Gulf Coast continue to push out steady diesel exports, making their way to Northwest Europe and likely placing further pressure on distillate cracks. Interestingly, in the freight markets, strong arrivals of these transatlantic diesel barrels added to MR supply pressure in Northwest Europe amid low gasoline loadings have been pushing voyage counts to historical highs. Upon arrival in Europe, MR operators were likely enticed to stay and trade in that market due to increased earnings in Northwest Europe as vessel supply tightened in the second half of July. This has alleviated some of the extra tonnage in the US Gulf Coast, helping to flatten out the volatility in prompt vessel supply and freight rates experienced over the last 2.5 months. If we take a look at the East of Suez flows, one of the most recent questions in the market is whether the Chinese refining system will respond to any extra clean product quotas granted and ramp up refinery runs. This could cause more exporting of clean products, even possibly to the Atlantic Basin. However, we see that seaborne exports from the region continue to take a sharp downturn, likely due to months of ongoing refinery run cuts, shutdowns, and extended maintenance. Even these low levels of exports have only barely provided a floor for product margins in the region. Considering the overall poor outlook for the region in terms of dampened industrial activity, possibly a mild winter, and vehicle fleet changes, we expect refiners to operate at continued low levels. The only caveat could be if the government grants larger year-on-year clean product export quotas to refiners, which could incentivize exports of middle distillates. Well, that is all we have for you today. Thank you for watching. We hope to see you at the Vortexa Innovation Series at various dates in September in Houston, New York, and London, where we get together face-to-face in person with industry participants to navigate key developments in the turbulent energy and freight markets. We hope you join us in September for the next edition of the US Energy Insights. Thank you for watching.